Digital assets can be anything. And I think that's important to know that you are not expected to know exactly what an NFT is. You are not expected to know exactly what a crypto is. Due diligence, my friends, making sure that you're aware of what it is and that you're protecting the assets that you're putting into place.
Hello and welcome to Simply Tax. It's Tuesday, March 29, 2022, and I'm excited to share with you on the podcast today a roundtable digital asset discussion with Geron Morgan, Brian Condron, Jeremy Goss, Tom Haldiman, and Neal Maddy, led by previous and returning podcast guest Nik Fahrer. Now, while I may be known for my attempts to combine dad and tax jokes pretty much anytime the opportunity presents itself, and to be honest and fair, probably a few times when it actually really doesn't, I'm not known for my digital asset discussion, or as I'll call it, dad. So I'll step back and let Nik Fahrer, who has made a name for himself, lead our discussion today, which is wide-ranging, and I'll say significantly up my game on the why, the what, the risks, the opportunities, and the latest in the digital asset world. As you heard Geron mention at the top of the episode here, there's a lot to learn, and it's okay that you might not even know where to start. But I promise you this, if you listen in and take some notes on the discussion today, you are bound to feel more confident in this growing and exciting area that has already had a significant effect on the global financial landscape. I guess what I'm going to do is I'm going to tee it over to you, Nik, to introduce who you are. I mean, we've had you on the podcast before, but I think it's always helpful, especially when there's been time in between, things change and to talk about kind of who you are and what you do. So why don't we start there and then we'll get going into the conversation.
Yeah, thanks for the introduction, Damien. As you mentioned, I've been on the podcast a couple times before to talk about crypto, and I guess to that extent, you could call me a crypto nerd if you want.
I'm going to call you a crypto nerd.
I even had somebody at our leadership conference come up to me and say, "Are you crypto Nik?" And I gave him a kind of a funny look, but yep, that's me. I'm crypto Nik. So I spend most of my time in our national office tax group helping out with several different initiatives, but mostly growth and technology initiatives, and just have a passion for crypto. So that's what brings me here today. With that, I am going to just go around the horn and ask everybody else to introduce themselves here. I'll start with Neal. Would you like to introduce yourself?
Sure. Neal Maddy. I'm in the Kansas City office. I'm in our SALT group, and I've only been with the firm for about 6 months now, joined back in August. Been really enjoying it, and I'm really excited about this group and this conversation. I consider myself a crypto native, so I'm really looking forward to this conversation.
Awesome. Thanks, Neal.
I'd like to cut in here real quick to add an introduction for Geron Morgan, who I caught up with in a separate conversation, but it fits well into this discussion. You can catch the entire video of that conversation that focused primarily on audit internal control considerations related to digital assets on our YouTube channel at youtube.com/simplytax. And we've also included a link to the video in the show notes of this episode, available at bkd.com/simplytax.
My name is Geron Morgan. I'm a partner and I work predominantly in our financial services group. So I work with banks and common trust funds, investment broker dealers. And my relationship with crypto has been very much an enthusiast and someone who looked at something that was new and emerging and saw something very powerful about it. When it comes to what I trade and how I, transact in it, I'm probably very basic. The things that interest me about it are the audit factors, what I see happening for our clients, what I see the potential to be to business. And so that's pretty much where my focus is. And so I take a very broad perspective on a lot of different things, a lot of different industries. When I look at it, not just my own. That's kind of me and my relationship with crypto and digital assets right now.
Brian, would you like to introduce yourself?
Hi, everyone. My name is Brian Condron. I'm a tax director out of our Austin, Texas office. I'm in the private client group where I primarily work with entrepreneurs in the Austin market. And over the last couple of years during this COVID time, a lot of technology companies and entrepreneurs have been moving to the Austin area. So very busy working with them. And I would say at least half of my clients have some type of exposure to cryptocurrency, whether or not it's their personal investments or their actual companies are involved with the technology. So a lot of exposure there. And then personally, I've been investing and kind of researching in the space for several years now. So excited to be part of the conversation.
Yeah, that's awesome. It's exciting to see that you have a lot of clients that you're helping serve in the space already. So thanks, Brian. Tom, would you like to introduce yourself?
Sure. Thanks, Nick. Yeah, Tom Haldiman with BKD Analytics. I'm a director in that group, which is a fun group. A lot of technologically minded folks get to use some cool tools, and it kind of is the same reason why I'm interested in cryptocurrency and blockchain. Is I'm really into tech. I always have been from a young age, and just enjoy learning about what are the new ways that creative applications and new tools that people are developing. So I really come at crypto from the technical mindset of, okay, why does this work? People say it's immutable. People say, you can make these transfers and they're anonymous. And okay, I really want to dig in and understand the technology that's driving that and how that solves those problems.
Yeah, Tom, you bring up a good point. It's a new technology, and so we have to have those people like you that look at it from a technology perspective. So, Jeremy, would you like to round us out here?
Yeah, so thanks, Nick. Jeremy Goss. I'm a financial services partner in New York office. I guess the reason I'm here primarily is because I've worked with clients in this space, primarily from the audit and consulting side in my career over the last like 4 or 5 years. Some household names, some like brand new startups. It's been great to work with companies who are actually trying to figure all this stuff out. And also, I've had the opportunity to sit on the ASCPA's digital assets working group for the past few years, and really talk with other firms and market participants about how to deal with this in an environment that's not regulated yet, and we don't have like standard rules. So a lot of fun.
Thanks, Jeremy, and exciting to learn a little bit more about all of you that's going to join us here today in this episode. And with that, I just want to say that if you're a listener, we probably won't go into too many of the basics of what cryptocurrency is or what blockchain is. And if you are interested in that, we have a couple other episodes number 75 and 82, that you can go back and listen to for some basic, more rudimentary information on these topics. But I want to dive in here and get your guys' opinion. The digital asset industry has exploded onto the scene here recently, topping a $3 trillion market cap in 2021. So my question is, why? Why is that the case? And what problem are digital assets solving, and why are they important?
Yeah, maybe I'll kick it off here. Thinking through like why was it made in the first place is that's the lens I'm looking at this through. Is it was created by obviously an anonymous person, but people know like kind of who the people that were involved in some of the discussions about some of the concepts that created crypto in the first place are, and so we can kind of look to some of their thinking around this. And a lot of them were frustrated with the inflation that they were seeing. They felt like there's got to be a technological solution to this where we can operate kind of outside of the government. So it's kind of a bit of the Wild West to some extent minded sort of folks. And so they wanted to have a currency that wouldn't be devalued through inflation, that was kind of out of their control. They wanted to have a little bit of that control in their hands, but also they felt that there were, well, whether or not they thought this or not, I shouldn't say, but there are some problems that it solves that are completely unrelated to that. One being that we're kind of spoiled here in the United States. We've got very mature financial systems. We've got PayPal, we've got Venmo. So, why mess with crypto? Can't you do all that same stuff with those applications? And the answer is yes, but there's a substantial number of people in the world who don't have access to those sorts of things, and they can't just send money electronically very easily. And so really you got to think of it from a global perspective instead of just a United States perspective whenever you're thinking about the problem that Bitcoin was trying to solve. I'll let some of the others talk about some of the other problems that are solved through things like distributed autonomous organizations. I know, Brian, you know a ton about that. And I know that there's other thoughts that people here have as well about other problems that are solved, but that's a few points that I think about.
I'll jump in next. I think those are a lot of great points. And speaking of PayPal and Venmo, I think crypto kind of falls into that whole Web 3.0 concept. And so PayPal and Venmo, those are kind of part of that Web 2.0 movement, which is the internet most of us know today. And some of the other big companies, Google with search and social media, Facebook and Twitter, e-commerce and Amazon, and mobile apps like Uber and Airbnb and so forth. With Web 2.0, that allowed the user to create user-generated content like blogs and social media content. However, as we've all seen, some of these tech companies have grown into a massive size, and they've done that by basically taking user data and reselling it, for the most part without user consent. So where Web 3.0 comes in, along with cryptocurrency and kind of leveraging that blockchain technology, is it creates this new phase of the internet where it plans to kind of shift power away from these big tech companies that are centralized and are now shifting to decentralized platforms and networks, leveraging blockchain technology that it will allow users to kind of have ownership and control of their own data. And so I think the goal is that these Web 3.0 companies will be paying users to use their data and resell it, right? So that's kind of one huge opportunity that could potentially disrupt a lot of these kind of legacy Web 2.0 companies that I'm really excited to see, where that goes.
Yeah, Brian, I totally agree with that. And I think throughout all of these discussions that we're going to be having today, you're going to kind of hear this undercurrent of, the democratization of information and being able to own, this kind of Web3 concept of being able to kind of own as a group and govern as a group versus the centralization, kind of like our traditional financial system has been. It's really interesting because the use cases that do come up right now, if you're just kind of a participant in this market, like trying to figure out what's going on, it's very confusing sometimes because a lot of the organizations and the centralized organizations that are out there actually run contradictory to the underlying concepts of the blockchain, right? Because they're not supposed to be centralized. So there's definitely that push and pull that you have going on right now in the market.
Yeah, Tom, I want to go back to something that you said. You mentioned that, outside of the US, there's several areas of the world where, maybe banking isn't as easy as it is here in the United States. But I'm going to assume that probably a lot of our listeners here are in the United States. So if I'm in the United States and I can use Venmo or PayPal, why do I care to use crypto instead?
Yeah, and that's a tough one to answer. And what is the incremental benefit of using crypto as a payment method in the United States? I don't know that there is one, to be honest with you, but there's a lot of other things that are built on top of the same technology that crypto uses, the blockchain technology, which I think of blockchain technology just as another database structure, which has amazing control over what can be input into it. You can't change it. NFTs are a big one, and I know we're going to get to that later in the podcast. So I don't know, Nik, if you wanted to steer that direction or.
Yeah, go ahead.
Yeah, so NFTs stands for non-fungible token, and what most people are familiar with is Bitcoin or maybe Ethereum or just the general term of cryptocurrency. And those are all what we call fungible tokens, meaning one is the same as any other. It's just like a dollar. If you've got $1 and somebody else has $1, you could swap and doesn't matter. It's the same thing. Whereas a non-fungible token, it's not fungible. It's very unique. It's an individual token that represents an ownership in a thing, and that thing can be an electronic thing or it can be a physical thing. So, where we see NFTs primarily right now is in art, digital art specifically. If you're an artist and you want to sell a piece of digital art, that's typically been a very difficult thing to do because anybody can right click and save that art. And so, how do you prove who owns it? And with these non-fungible tokens, again, going back to what I said about this just being a database, that creator can go into that database essentially, conceptually, make an entry that says, I created this piece of art and I'm the owner, and then that token can be transferred to other people. They can buy it and they can prove, yes, I own this particular piece of digital art. And that's just kind of scratching the surface of NFTs, but that's a pretty interesting reason why people in the United States should be interested in this discussion.
And Nik, just to chime in there, your question is, why crypto versus PayPal? And obviously crypto is still very early on. We're still kind of in the first innings, but I think the idea is that you don't need a PayPal anymore. PayPal is this centralized authority, this middleman that's tracking all of your data, seeing what you're spending your money on, and then ultimately probably reselling that data or using it for their benefit. And so by eliminating that, eliminating those banks and those brokers, the idea is that you will have self-custody of your own assets, your own money. You don't need a bank. And hopefully the transactions will be cheaper and faster. And ultimately it's kind of a win-win for everyone, right? And so I think that's kind of really the long-term goal. And then you kind of throw the transparency on there with the blockchain of being able to see who's sending what where to kind of eliminate maybe some of that potential fraud. But I think that's kind of the ultimate goal.
Good points there, Brian. Neal, I know that you have some personal interest in crypto and have done some investing on your own. What's your perspective here?
Yeah, I think for me, we talked about Web 3.0 earlier, and when we look at Web 1.0, we were just able to read on the internet, and then Web 2.0 came along, and we could read and we could write using applications like Facebook, Instagram, etc. And now in this Web 3.0 era, we're going to be able to read, to write, and also to own. We're going to be able to own our own assets and our own self-custody as part of this new wave of the internet. And that's what I'm really excited about is this ability to own. And that's where I think NFTs are going to play a huge part. And we might talk about this later, but part of that ownership will come into play in different areas like gaming, for instance. Before, when playing different games, you might have a character, but that asset, so to speak, is part of the company, whoever is making the game. You can't buy and sell that per se. But in this new wave of the internet, in this Web 3.0 with cryptocurrency blockchain, you'll be able to own those gaming assets and then buy and sell them as you see fit.
I think one thing that is a misconception right now is that NFTs are solely for digital art. And that may certainly be its first and most common use case, but you all have alluded to other use cases for NFTs. Can you kind of expand on that and talk about what else we can use NFTs for other than just digital art?
I'll jump in there. Even talking about digital art, one of the other reasons that NFTs is so attractive to artists is that, let's say you sell your painting for $1,000 and then you find out 10 years later the guy who bought it just sold it for $1 million. You didn't benefit from any of that appreciation. So these NFTs are typically combined with a smart contract, which maybe we can get into later. But typically, as part of that smart contract, it's going to include kind of a residual commission or royalty on any future sales. So if you sell that digital art for $1,000, you'll get 1,000. And then if it sells for $1 million some years later, you would get, say, 10% of that. You'd get another 100,000. So there's really incentive for you to see that be sold multiple times on the secondary market, and because you get to benefit. And that's something that has never really happened. And when you look at from that perspective, really any digital assets, whether it's Nike selling, digital sneakers in the metaverse, or you selling really anything, you can capture a royalty stream off that, and that can be really significant. And the one other area I'll tap on is kind of music royalties, which those are artists as well. In the past, musicians were really dependent on music labels and distributors and things like that to get them out there, and without that, they had no chance. And so in today's world, what musicians can do is they can sell royalties or sell a stream of royalties in exchange for money today in the form of an NFT. And they take that money and help them actually go out and produce that album or that song. And then, kind of their early supporters and fans that have NFTs, they'll get a stream of royalties depending on the success of that music, as well as maybe some VIP access to kind of behind the scenes with that artist. So those are some really exciting things. I'll let maybe someone else touch on the metaverse and the ability to transfer assets across metaverses and get into that and how important that is and how that was never something you could do in kind of with traditional video games.
Well, I'll just butt in briefly there and just kind of finish off with what Brian was saying. I think it's really exciting where these artists are able to do this. I think about when I was younger and some of the artists that were up and coming that I found out about when no one really knew about them. I was like, I think this band's really good. I think they're going to go somewhere. I wished we had this technology that we have now back then, because if I could have invested in those bands, I think I would have made a killing. But it really is interesting in that it's going to allow this technology, I think, is going to allow everyone to become a venture capitalist of sorts, where you're going to be able to more easily put your money into projects and people you believe in. That really wasn't possible before, because you had to, in order to get involved in that game, you need more capital, you need more infrastructure. But now I don't think that's going to be as much the case anymore, as we are able to kind of get rid of some of these middlemen.
We did a project for a university a long time ago, and it got me really thinking about, NCAA sports and how these kids run risk of injury and ruining their careers before they even make any money. And I've always thought, boy, that would be nice if you could make a contract with a potential future superstar where you said, I'll give you this amount of money for a potential percentage of your future earnings, a revenue stream in the future. So Neal, I think that idea of being able to invest in anybody, that would be, I would think, one interesting application. Obviously there's a lot of legal hurdles you'd have to clear there, but just the concept of that, I think NFTs and smart contracts together could potentially be an interesting solution to that problem.
Okay, so I've heard this term a few times now, smart contracts. I know what a smartphone is, and our listeners probably know what a smartphone is, but can you tell me what a smart contract is?
A smart contract is really a contract that you would put on the blockchain that relies on if-then logic is kind of how I like to think of it. Like in your contract, you could say, if this certain event happens, then this contract will execute, and kind of the easiest one to, it's not really that useful for most people besides maybe crop insurance folks, but if we have a certain number of rainfall during this season, then this event happens, which actually, now that I say that, that's a pretty good application that crop insurance, they might want to actually look into smart contracts for that reason. So it takes the decision making out of a human's hands and puts it into code, basically. So on the upfront, you and another person might say, okay, if I give you $100 and I'm paying you for this insurance, at the end of the season, if we don't get enough rain, then you give me $200, and if we do, then I give you another 100. Or I'm not sure exactly how that particular example makes any sense, but that's the idea, is that you can put sort of if-then logic into a contract, and it happens regardless. And so it requires you to put cryptocurrency, like in that scenario, you would put the cryptocurrency, kind of lock it up until those decisions were made. In the case of rainfall, that's not a decision that's made. It's just yes or no. And once that is resolved, then the money would go to either the person that put the money in the first place, or the money that they said it would go to if that particular event happened. So maybe not the best example in the world, but at its core, that's what it is. But I know these other guys can give a much more eloquent description.
Yeah, I mean, I think that's a great example. I mean, insurance is actually an area where they are trying to decentralize. And I think the whole idea and the theme here is they want decentralization. They want to get rid of the middleman. And so smart contracts are really coming in to remove the middleman, someone that you might have needed to handle an escrow, or an insurance person to release proceeds, or a trustee over an estate, where if a kid reaches 30 years of age, he gets X percentage of an estate. That's where smart contracts can come in, and you can program them in a way where when a certain condition is met, it automatically executes that contract or agreement. And so as we kind of touched on briefly here, DAOs, decentralized autonomous organizations, are built completely on smart contracts. That's what makes them decentralized and autonomous. So we'll touch on that later, but I think the whole point is these smart contracts, which were initially built on the Ethereum blockchain, this is how we get rid of the middleman. This is how we execute and complete contracts without someone in the middle having to approve it.
That's a great explanation, both Tom and Brian. Thank you for that. Before we jump into DAOs, I think a good segue first for our listeners is to first understand what decentralized finance is. And it's very commonly shortened and abbreviated as DeFi. I know that there's more to crypto than just buying some Bitcoin or Ethereum on a centralized exchange like Coinbase and just speculating that the asset will rise in price. So can you guys talk to me about what DeFi is and why I should be interested in DeFi?
I'll go ahead and kick it off here. I think that term is thrown around a lot in this space, and it can mean lots and lots of different things to different people and different activities. Decentralized finance can basically be the same concept of us, what we're talking about now, kind of this democratization of finance and taking it out of the realm of a centralized intermediary. It can also mean like lending type transactions. You'll hear it a lot in that regard. Basically, if you take anything within the traditional financial system right now, there's probably a decentralized finance concept that does something very, very similar. There's a lot of mirroring there, and really what it's trying to do is take out these centralized counterparties. And I know we'll get to this a little bit later, but every single like benefit that we're talking about here also comes with risks and regulation and all those sorts of good things too. So I'm sure we'll get to that a little bit later, Nick, but I just wanted to point that out now that there are things to think about from that standpoint.
So you're telling me not everything's going to go to the moon?
I'll let somebody else throw out a few more examples of DeFi before we go there.
I'll jump in here. So just in the news, someone just bought one of the Crypto Punks NFTs, which Crypto Punks were a really popular digital art project where there was a limited supply, and so of course the value has increased significantly. But someone bought a rare Crypto Punk for $24 million, and they didn't just buy it with Ether, which is the token for Ethereum. They actually used DeFi to borrow using their ETH as collateral to buy this, because he didn't want to. He would rather pay, whatever the interest rate is on that loan than give up the potential future appreciation on the Ethereum token. So it kind of combines a couple of the different concepts we were talking about. But some of the other areas in DeFi, and the way I kind of look at this is, right now, if I want to get money out of my bank, I have to go to my bank. I have to go to my bank's website. I kind of have to ask for permission in a lot of ways. But with DeFi and this self-custody concept, I can have my own digital wallet and have my own cryptocurrency in that wallet and do what I want with it anytime. I don't have to ask for approval. I don't have to deal with wires or transfers through a bank. And also, right now interest rates are so low. In my bank account, I'm probably earning a fraction of a percent in interest rate, whereas I have the freedom using cryptocurrency. Yes, there's a ton of risks here if you don't know what you're doing, but you can earn a significantly higher interest rate through a variety of different decentralized finance protocols, such as staking or providing liquidity to a liquidity pool. And a liquidity pool is basically the pool of cryptocurrency that a decentralized exchange would use. So a Coinbase or an FTX or some of these other big exchanges, they're centralized because you've got one company running it. There are actually a lot of decentralized exchanges that are actually running autonomously and are running because users are providing liquidity and then doing peer-to-peer trades between each other. So there's a lot of really interesting concepts in DeFi, and it's one of the areas that is just changing almost daily, and it's extremely complex, very difficult to track from an accounting and tax perspective.
One thing that you mentioned there, Brian, is this idea of trying to earn more money than what a traditional financial institution could pay me with just interest sitting in a savings account right now at a fraction of a percent. What are some of the ways that people are doing that? You mentioned a couple, like liquidity pools and staking, but can one of you dive more into what that looks like and kind of maybe some returns that people are seeing in this market?
So staking is a very popular one, and to understand what staking is and what that's all about, you have to understand the difference between essentially, now technically there are more, but for our purposes, when we talk about blockchain consensus or how a block is created on a blockchain, you either have a proof of work consensus method or you have proof of stake. And so Bitcoin is the one that uses proof of work mainly. Now Ethereum also uses proof of work, but is going to migrate to proof of stake. And then many other newer chains are using proof of stake. And one of the reasons for that is proof of stake, it's a lot more energy efficient. And that's kind of one of the big complaints about Bitcoin is there's a lot of energy consumption. So a lot of people don't like that for the environmental impact. But these proof of stake chains are much, much, much more energy efficient. But in order to get that blockchain to work in proof of stake without the proof of work mechanism, What you need is you need to be able to take the coins from the blockchain and have people who own those coins essentially give those to the validators who are creating the blocks. And then as those delegators give those validators their coins, they're able to earn essentially interest on those coins. So if I were to have, let's say, 100 of X coin, and I give that to a validator, maybe I might be earning anywhere from 5 to, I mean, there are some that are crazy high, and that's because they're highly inflationary. But you could see upwards of 50, 60%. But again, they're highly inflationary, and if people aren't having a high demand for those coins, what you're just going to see is you're going to see just kind of a depreciation in the value of those coins over time. You can also have stable coins. That is a good method to do if you're worried about the risk of either appreciation or depreciation on your coins. There are lots of stable coins out there that you can use that aren't going to move in value. They're essentially pegged to the dollar, and that way you're able to earn a higher interest rate than you would on money in the bank by just using these stable coins, and then either staking, or in case of a stable coin, I guess you would just put that into a liquidity pool, and you're not going to see the value of that move as long as it's paired to another stable coin.
The bottom line is decentralized finance is the idea that you get to be your own bank, right? I mean, in a traditional world, you deposit your money into a bank. They pay you a minimal interest rate. Yes, you kind of have the safety net of having that bank and the access to the funds, but they go out and then take that money and then lend it or invest it elsewhere, right? They're benefiting from that kind of the arbitrage between what they're paying you and the rate they're returning elsewhere. Where with DeFi, you get to do those things. You get to keep custody of your assets. You get to stake it. You could stake it, and then you're earning that kind of interest rate, which is paid out in token rewards. As you're staking it, you could also be borrowing against it to then invest into other areas. So you have a lot of flexibility, and it can effectively act as your own bank. And so it's a really interesting concept.
And just that idea of being your own bank, may not resonate with everybody, but I tell you what, the first time I had kind of the aha moment of this is really, really cool. I was out with some friends playing disc golf. One of us bought the beer and we needed to pay the others back, split the cost and everything. And at this time, I didn't have a Venmo account or a PayPal account, but me and my other buddy both had a little bit of Bitcoin on our phone, essentially. You could argue about where those private keys are and all that, but to a normal, average, everyday person, it looks like the Bitcoin is on your phone, and you can just boop, do a quick transaction where you scan a QR code on your buddy's phone and send them, any amount of money, which at the time, the transaction fees were reasonable for Bitcoin. If you tried to do that today, I think you'd probably pay about $20 to execute that transaction. So things have changed a lot since then, but that early on, that feeling of just being able to, it feels just like handing somebody cash, but it's just going from your phone to their phone. There's no financial intermediaries whatsoever. It's a unique experience, and being able to do that with all these other items beyond just the currency, which is what the core of DeFi is, what Brian was saying, is just it's pretty darn cool. It's a pretty darn neat experience to know that you've got that complete control, but also risk too. Like if I would have dropped my phone in the lake that day, that would have been not ideal. So there is definitely risk and enjoyment as well. Yeah, don't be putting a lot of money on your phone, I guess is the takeaway there. Just put small amounts that you can pay your friends back for items.
Well, maybe it'd be a good opportunity for us to talk about how these wallets work, talking about hot wallets, cold wallets, seed phrases, and getting into that.
I think that's a great idea. Neal, you want to take it away?
Yeah, sure. Being able to hold your assets, your cryptocurrencies in self custody, as Tom was saying, it's pretty neat being your own bank. But to do that, you need to be able to hold that somewhere. And in crypto, we usually refer to that as either a hot wallet or a cold wallet. So a hot wallet is probably going to be something like Tom was describing, where you just have it either on your phone or maybe a browser extension on your computer. There are a number of different wallets out there depending on the cryptocurrency you own. They can be very customized. But these hot wallets, they are deemed to be a little bit less secure than a cold wallet. Now, a cold wallet is going to be essentially a USB stick, essentially, where you're holding the data for your cryptocurrencies. For both of these, what you're going to have is a seed phrase, and they're usually 12 to 24 words. They're randomized when you create either the hot wallet or receive the cold wallet. And it's really, really important. I can't stress this enough. Do get into crypto and you're using either a hot wallet or a cold wallet. Never, ever, ever give anyone your seed phrase. If someone asks you for your seed phrase, 99% of the time, it's someone who's trying to scam you. And the other 1% of the time is some development team that they're either not very good or they're being lazy in their coding because they need your seed phrase to activate, whatever it is that you're trying to do. And so that's if there's one piece of advice that I want everyone to follow is never give anyone your seed phrase ever.
Probably a good point to clarify for some listeners too is, a lot of people that buy and sell Bitcoin are doing this on an exchange. I mean, someone else is holding your private keys. There's no seed phrase. So if you're just operating like on a Coinbase or something, in many ways the benefits you're not even seeing because it's just sitting on their books. They're controlling the private keys and all that. What we're talking about is if you want to move outside of that ecosystem, the Coinbase ecosystem or whatever exchange that you might have purchased from, and actually transfer control of the actual coins to yourself, that's where you start getting into these hot and cold wallets where you're actually in control of the keys. You're at risk if you screw something up that you will never get that money back. You want to educate yourself if you're getting into the controlling your own keys aspects of this and understand that now, if you are operating with a hot wallet, meaning it's connected to the internet, if you don't have good security on your home setup, somebody could potentially hack and obtain those. Whereas a cold wallet, like Neal was explaining, oftentimes is a USB stick. It can even be just having the key printed to a piece of paper, and you can do this completely offline if you're so inclined. If you're very paranoid or you have a very large amount of money, I mean, some people even download a program onto an offline computer, generate the keys there, and send money to those keys, which I know is getting probably more technical than our audience is interested in. But I just wanted to make the added distinction between there's hot and cold wallets, but then there's also having a third party control your keys, which is like a Coinbase or an exchange.
Yeah, thanks for that clarification. And if you're someone who is not ready to jump into the DeFi world and take that risk, then yeah, you really won't need to worry about that. If you are, then that's something you'll definitely want to research and learn more about.
Yeah, and one key point there, just if you are using a Coinbase or a third-party exchange to hold your assets, most, if not all of them, provide two-factor authentication, and that's always a good idea. So no one can get into your account there with just a password, because that password is essentially your private key or is essentially your passphrase in the terminology that we've been using here. So make sure that your two-factor authentication's on.
Yeah, so I want to elaborate a little bit more on something that you guys have kind of alluded to. If I'm just a traditional investor, I go out to Coinbase or a centralized exchange and buy some Bitcoin, Ether, or what have you. It sounds like to me that I can't take advantage of some of these other things like staking or other DeFi protocols that you guys were talking about. So can you kind of walk me through what that process looks like and how I could take advantage of some of these things?
I will say that a lot of these centralized exchanges do provide some level of DeFi. I wouldn't say it's traditional DeFi because you're on a centralized platform, but a Coinbase or an FTX or a Binance, they offer a lot of staking, which is kind of a form of DeFi, except that you're still on their platform. Some offer lending and a variety of other services. I'd say Coinbase, because they're publicly traded on the US stock market, is probably the most conservative of all the exchanges, and they typically have more due diligence behind a lot of the tokens and things that they offer. But there are certainly other centralized exchanges out there that have a lot more creative investing opportunities. But Nik, to your point, if you really want to get into the real DeFi world, you typically have to transfer your assets off to a wallet and then through then connect into those kind of decentralized applications where you have a lot more flexibility to lend or to borrow or stake, less common tokens or get into liquidity pools.
One thing I would add to that is if you are staking on a centralized exchange, you're probably going to see a lesser yield because that centralized exchange is going to be taking part of that keeping it for themselves. So just one example that I'm aware of, there's a particular cryptocurrency called Atom, and I think it offers like a 5% yield on Coinbase, whereas if you were staking it via your own wallet, you'd probably be yielding closer to 13 to 14%. So just something to keep in mind of, yeah, you can on a centralized exchange get some yield like that, but it's typically less.
Yeah, that's a great point. I think Coinbase kind of discloses that they charge this commission, and it's actually pretty common in the industry. So there are a lot, like Ether, for example. I think you need like 35 ETH to be your own validator, and so most people will contribute the ETH that they have to a staking pool, and then they kind of pool all their ETH together. They meet the 35 ETH requirement, and then they could start validating transactions and getting paid out in ETH rewards. And so even when you join a staking pool, who's managing that pool typically will charge a commission similar to that, but Coinbase and some of these exchanges certainly charge more than you would get, and probably because their platforms maybe have a little bit more security around it. And then there are others like what you mentioned, Neal, where you can actually just go directly to those platforms and stake them in your own wallet and kind of get the full yield as opposed to splitting it with someone else.
Okay, so I got $1 million question for you guys. I think everyone is dying to know. If I get involved in crypto, is it anonymous?
Who wants to take that first?
I would say it's pseudo anonymous. Every wallet has a distinct wallet address, and if your wallet address can be connected back to you personally, then you are instantly known. You're doxxed forever. And because part of the issue there is if your wallet was known, you could transfer whatever asset you have in that wallet to another wallet, but that lives on the blockchain. And so they would be able to see that transfer from that original wallet to the new wallet, and they would still know it's connected to you. So it is anonymous unless this is my understanding at least, it's anonymous unless people know about it, and then you're forever doxxed.
Right, there are pretty sophisticated companies out there dedicated to figuring out what's going on these various chains. Chainalysis is one that has been able to identify a large portion of the Bitcoin blockchain and some others, Ethereum, and actually determine where these funds are going, who owns what, and you can look out at that information. If you have a few $1,000s in a wallet somewhere, I mean the risk is much less unless you actually put your name out there and let somebody know what addresses you actually own. I don't know, Brian, be interested to get your take on that too.
Yeah, I mean, I think one of the benefits of blockchain technology is that it's completely transparent. You don't necessarily know who owns the underlying wallet or the address, but you can certainly track it, all the transactions. And I don't know if you've been watching the news, but there was this $4 billion of Bitcoin that was stolen. Obviously, it wasn't worth that much in 2016 when the hack occurred on, I think what was the exchange, Bitfinex. Someone somehow stole, I think at the time, like $70 million worth of Bitcoin, and obviously that's gone up significantly, so it's worth $4.5 billion today. They found those people. There have been some other hacks too. It's very hard to actually get that money out and convert it to cash and get away with it. And I think that's the reason why they still had so much money in this wallet. And they probably weren't the smartest people because I think their name was somehow attached to the wallet. So it was pretty easy to track down once they found it. In some cases, it can be easy to hack some of these new decentralized applications, but it's very hard to actually take that money out and do something with it. I have heard of there's an application called Tornado Cash that a lot of hackers supposedly try to use. And what it does is it mixes your transactions with a bunch of others and tries to kind of like scramble them all up, so it becomes almost impossible to track. And so it like takes your Bitcoin and that, for example, it mixes it with a bunch of other people's Bitcoin and it kind of spits it out. And supposedly that's what people try to use, but it's still somewhat traceable if you really have the technology or the experience to kind of audit those transactions.
Yeah, I would say your on ramps and your off ramps are points at which personally identifiable information get involved. So if you're just someone sent you some coins and you never had any connection to an exchange where you had to go through the know your customer process and all of that, I would say your profile is going to be a lot lower than if you did, set up an account on an exchange where they've got to gather all that information, because now Now they've got that information, so potentially, if somebody had information about your Coinbase account and saw what transactions went out of that, then they could trace you. So I'm just thinking through, like, how could you become not anonymous? And I mean, it's just like any kind of investigation, what evidence is there? And the more potential evidence there is, the more likely that it could be traced. But yeah, I mean, with the mixers and the tumblers that Brian mentioned, you can muddy the waters quite a bit, but I would never say that it's 100% that you're completely anonymous on any of these cryptocurrencies.
Yeah, and I would say right now there still aren't a lot of ways to get cash in your hands, right? And so typically you've got to go through a centralized exchange, and so you'd have to transfer from your wallet to a centralized exchange and cash out in most cases. And so when you do go through that transaction, typically you're going to have to provide some type of personal information. And so, to your point, until in the future where they could just take Bitcoin and buy everything they need at the grocery store, buy cars and all these different things, which we're currently not there yet, I think it's just really hard to actually use it. And so that's why you see a lot of people that are hacking these exchanges and they just have money sitting there because they don't know actually what to do with it, other than possibly, maybe they could do some type of off-chain transaction where they're selling their wallet to someone off the blockchain for cash or something along those lines. But I think it's a very difficult thing to do nowadays, and it's only going to get harder with better technology.
And just one more quick point too. There's definitely people that want to be anonymous, and there's enough of these people that they've actually developed certain cryptocurrencies that are geared towards anonymity more so than Bitcoin and Ethereum. Like Monero and Zcash are a couple that I remember from that have been around a while. And I remember when they first kind of came out, that was their whole kind of marketing shtick, was that they were much less likely to be traced to you.
And even those currencies typically have settings where for a particular wallet, the privacy can actually be turned on or turned off. So if you see like your centralized exchanges trading those type of assets, typically the privacy is turned off on those assets for that very reason, because those are regulated exchanges that that have to be able to conform to those know your customer policies and all the various transactions.
Yeah, and one thing I've been hearing about too with stable coins is, although they should be truly decentralized, a lot of times the companies that have created these stable coins are actually freezing people's assets when they find out that it may be suspicious activity. And so they're kind of acting like a PayPal in the back end where they're freezing, say, well, I don't know what's going on here. It seems suspicious, so I'm going to kind of freeze these tokens. And so I have been hearing about some stable coins doing that to kind of prevent the laundering of money.
Yeah, and typically they'll get notices from, say, like the Treasury, from like or from law enforcement, and say, hey, we noticed some activity on this account, so they'll for those reasons they'll freeze them. And even if you look at the Treasury's OFAC list, so the listing that shows various accounts that if you're a regulated financial institution you're not supposed to trade with, there's cryptocurrency addresses on that list now. So they're out there for all the world to see that, hey, shouldn't be doing business with these addresses.
Yeah, we've mentioned stable coins a couple times here, and Jeremy, I know you know quite a bit about stable coins, but maybe before we jump directly into stable coins, I want to hit on one more thing as it relates to the conversation that we just had around anonymity and crypto. A lot of what I've read, a lot of what I've heard from people is that they believe that crypto is just being used for illegal activity. If somebody approached you all with that concept, what would be your rebuttal to that question?
There's probably a couple things I would say. One is we already have fraud and money laundering in our current system, to a much greater degree than we're seeing in the cryptocurrency space. The other thing I would say is, if I were a criminal personally, I couldn't imagine thinking it would be a good idea to transact on the blockchain to do my criminal activity, because every transaction is recorded on the blockchain and it's criminal. It's like that's the last thing I would want, is for my activities to be recorded forever. It just seems like a terrible idea. I'm sure there will be money laundering and that kind of activity happening in blockchain and in the cryptocurrency space, but I think some of these concerns are overblown. And as we've already seen, the authorities have been able to, in some of these very large cases, find these people and seize the assets back.
And I completely agree. And I would also say that anytime you have a new technology, a lot of people jump in solely for money and try to take advantage of it. But there are a lot of great use cases for blockchain technology, and we've already touched on a lot of them with NFTs and decentralized finance and with artists and things like that. So I think over time, as these use cases become more obvious and developed, money laundering and illegal activities won't be as big of a deal.
It's a big focus right now for Congress, for regulators. I think that the US wants to be at the forefront of regulating this market. If you listen to Congress, they would love to just bring it all inside the traditional financial system, right? So there's this push and pull between those who want it within the financial system and then those who actually want to keep it completely separate. I think we're going to see a lot more of that in the next year as Congress has kind of dedicated time to looking at this more, as has the SEC, the CFTC, OCC, all your various regulators out there.
Yeah, definitely some good points there. Okay, Jeremy, I'm gonna put you on the spot here. I've heard us mention stablecoins quite a bit, and I've also been following the Winter Olympics in China, and know that China is introducing this new idea of a central bank digital currency. Talk to me about what a stablecoin is and what a central bank digital currency is.
Sure. So a stable coin is essentially just a cryptocurrency that is pegged to a fiat currency. So just like the US dollar or a basket of currencies. So the idea is that it does not fluctuate like a Bitcoin might fluctuate in price. It stays stable against that currency. And if you think about kind of the way this came about, if you are, it's very difficult, and it has been traditionally, to transfer in and out of, say, from like US dollars in your bank account to cryptocurrency. And it might take days to do that because it's got to kind of go over this wall of the financial system into the blockchain. So in order to kind of alleviate that and make the liquidity and create less friction within these markets, like let's say if you're trading on an exchange and you want to be trading in and out of cryptocurrencies, maybe you're trading Bitcoin for ETH for Solana, and then let's say you want to be able to go into US dollars to make your portfolio more stable for a short period of time before you get back into the other cryptocurrencies. Well, a stable coin allows you to do that. Before, you used to have to transfer it back out into, say, US dollars, and then transfer it back into the crypto. A central bank digital currency is just a stable coin that is issued by a central bank, by a government. Typically, when we say stable coins, those are privately issued. So there are centralized companies behind those stable coins. There are stable coins that are issued by DAOs that are more decentralized, but the biggest stable coins out there are backed by centralized companies, and then they have the underlying currency that supposedly supports the value of that. So if you have, I'll just use the case of US dollar coin as an example. If you have one US dollar coin token, then there'll be $1 sitting in a bank somewhere to underlie that stable coin, which is what keeps it kind of pegged to the US dollar.
So what can we kind of expect to see as it relates to stablecoins and CBDCs or central bank digital currencies in the future?
I think you're going to see this maybe across the rest of the globe in a little bit fuller force than what you might see in the US for a little while. A central bank digital currency in a place like China might be a little bit easier, where you have a lot fewer banks. Our banking system in the United States is different than practically any other banking system in the rest of the world. We have anywhere from 4,500 to 5,000 banks in the United States, whereas like the next highest number of banks throughout the rest of the world, I don't even, maybe just over 1,000. Our banking system is very, intermediated, and the central bank digital currencies, I mean, one of the biggest things there is that it will disintermediate that banking system. It will give the federal government the ability and power to essentially, send money to or receive money directly from its people. So, and another thing there is it kind of goes against the ethos of this decentralized world anyway, because you're putting all that power kind of in that central bank, right? So in the US, regulators and Treasury are kind of looking into it, but I wouldn't hold my breath there.
Fair enough. So maybe not a US dollar crypto from the federal government anytime soon.
Probably not.
Anyone else have anything else they'd like to add as it relates to stablecoins or CBDCs?
I'll just add one thing. Jeremy, you were talking about every stable coin is represented, supposed to be represented by a dollar in a bank somewhere. I don't know much about the USD coin. I know Tether has had a lot of bad news, accusations that maybe that's not happening with them. I haven't frankly kept that up to date with those, but does anybody have any interesting information about any updates on where Tether stands? I know for a while, people were clamoring for an audit for a company to come in and validate that yes, in fact, one coin does represent a dollar in a bank somewhere. But I don't know that that ever came to fruition. Does anybody have any insights onto, I guess, the auditing aspect of these companies that are issuing stable coins?
I'll speak to that a little bit, Tom. I mean, yeah, there was certainly a few years ago some chatter on that issue that you talk about there for Tether. I wouldn't speculate on exactly what was going on, over there. Broadly, yes, these are issued by centralized companies, right? So you have that same kind of concern and risk that are they really doing what they're saying they're doing? I can say that I worked with the issuer of USDC in the past, and I mean that is something that they claim. It's now a public company as well. But yes, there are certainly issues out there and discussion around whether that's whether what those companies are saying is actually what's going on.
So it sounds like regardless of if the Federal Reserve endorses a U.S. dollar stablecoin or not, we do have these stablecoins and that are pegged to the U.S. dollar right now. I think Tommy threw out one, Tether, and Jeremy another one, USDC. Are there others that are similar?
Yeah, I mean, I don't know that I could list all of the top ones right here. Like the Gemini dollar is out there. DAO is another one that's a decentralized stable coin. I don't know if anyone would like to speak to that a little bit more, who might have a little more technical knowledge about how that one works.
Yeah, and maybe that's a good transition here. Throwing out the term DAO quite a bit, and we're not talking about a Chinese philosophy. Whenever we say DAO in the terms of crypto, we're talking about a decentralized autonomous organization. So one of you want to elaborate on what that is?
DAO, like you said, Nick, is a decentralized autonomous organization, and it's decentralized and it's autonomous. And like we mentioned earlier, the idea is that it's run on smart contracts, which creates the autonomous component. So as certain criteria is met, contracts are executed. But the DAOs are exciting because they have a really interesting structure that could potentially disrupt the kind of traditional business structure that we're used to. You can kind of think of it as kind of a new LLC or C corporation, depending on how the structure the DAO is created. But it's basically a company that has no headquarters. It's built with smart contracts in the cloud, and they're governed by the token holders. So DAOs typically will issue a token, just like you might buy a token or Ether as a token. Each DAO typically has their own token, and anyone can acquire a token anywhere in the world, and therefore can vote and be part of governance. It's just this really interesting concept of really anyone can get involved, anyone can buy a token, vote on things, and going back to kind of that creator economy, where if you're adding value to these kind of Web 3.0 platforms, you're getting rewarded for it and equity. And that's like kind of where these tokens come in. They're kind of used to like stock options in today's world, where if you come into a DAO and you're saying, hey, I'm great at marketing, I'm going to help you market online and bring more customers your way, or they'll pay you in their token. And a lot of it is automated, where if you post on Twitter, they give you one token. If you do this, you get two tokens. And so it's just a very interesting way of doing it. There's no HR department typically. There's no employee contracts or salary negotiations. You get paid in tokens based on how the smart contracts are built. There are some full-time contributors that might get somewhat of a kind of a base salary, but for the most part, it's all through their tokens. And what I always think is interesting is, we had Web 2.0 with the Googles and the Facebooks, but with 3.0, because of this decentralization and because we're so early on in the industry, people that contribute or work at one DAO can work at as many as they want. There's no employee contracts, there's no non-competes. So imagine if, engineers at Google were working at Facebook and Apple and at all these different companies, I mean, maybe there'd be the risk of them stealing information, or maybe they'd be adding value across the board based on all the experiences they have. So it's just this really interesting concept, especially as, over the last several years, it seems like kind of that millennial generation is really interested in starting their own businesses and being independent contractors. And so this is a great opportunity for people to kind of add value and get paid based on the value that they bring. I think a lot of people think, hey, I've been working at this company for a really long time. I don't see the upside, or I'm undervalued. Where in this situation, it's based on merit. What you bring to the table is what you get. And so I really find that interesting. And so anyone that has any type of skill or value, or just great at building communities, can really just join these DAOs, reach out to them on their Discord, which is kind of like their social media platform they use to communicate. You can get in there and start getting involved and asking people, how can I help? Where do you need help? And people will be happy to kind of plug you in if you can add value, and then compensate you for it. And going back to the blockchain where we talked about transparency, these DAOs are for the most part are completely transparent. So I can go to a DAO's website, I can see how much people are getting paid, who's working on what their upcoming projects are. I mean, it's completely transparent. It's really amazing, and it's just so anti-corporate America, where everything's kept close to the chest. It's all secrets. No one knows how much each person's made, and it's all based on how long you've worked there. That dictates how much you get paid, kind of thing. So that's really interesting. And one kind of DAO that was famous towards the end of last year was the Constitution DAO. This is just one use case. There's obviously DAOs can be used for really any type of business that we currently have in today's market. But the Constitution DAO was formed last year with the goal of purchasing an original copy of the U.S. Constitution. It was at auction. And so they raised about $47 million in a matter less than a week to buy this copy of the Constitution. They ultimately lost at auction to some hedge fund manager, but it really demonstrated the ability for the DAO to raise money very quickly from average crypto users. And had they successfully acquired the Constitution, that truly would have been owned by the people. It's really interesting. And just being crypto, that Constitution DAO obviously offered to refund all of the tokens and the money back to the members because they didn't win the auction. But a lot of them decided, what, I'm going to hold back my token, because if I'm the last guy holding this token, it's got to go up in value, supply and demand. And of course, they raised $47 million, but now the Constitution DAO as of today has got a market cap of $350 million, but there's no underlying asset other than the fact that you own a token that was part of maybe one of the first kind of famous DAOs. So it's become kind of like a meme coin, like many others. So it's just a really interesting concept.
Yeah, that is super interesting, Brian, and I love that example that you gave there with the Constitution. Are there any other examples or use cases that you can give us to our listeners here? And why would I start a DAO? What sort of things could I do with that?
I think the idea with starting a DAO is to create just a decentralized platform for some type of business model. There are decentralized asset managers out there, like the Index Co-op DAO, which basically allows anyone to propose a new crypto ETF fund. And then the DAO, basically anyone who owns a token in the DAO can vote on, yes, we like this investment strategy, no, we don't. If they approve it, they approve it. And then that individual kind of becomes a new fund manager on their platform. And that DAO helps promote that fund. And obviously there's a kind of a management fee split between the manager and the platform. But that gives you an idea. You compare it to BlackRock, who's one of the largest ETF institutions out there. Good luck knocking on their door and saying, I have an ETF idea. You'd never get a call back, right? And so the idea of decentralizing this and allowing anyone that has a good idea to get rewarded for it is just a really interesting concept. I mean, there are like venture capitalist DAOs out there where basically they're similar to the U.S. the Constitution DAO, where they're pooling money together, and then as a group, they are voting on, yes, this looks like an interesting, startup that we should be investing in. And ultimately, if those startups are successful, the profits come back and are distributed just like a normal kind of venture capital fund. But you don't need a fund manager that you're paying 20% to or in a management fee to do that anymore, right? I mean, obviously there's a lot of regulation and things around that we haven't talked about yet, but it certainly is opening the doors to kind of traditional finance to anyone. Before, if you didn't have a lot of money, you weren't accredited, you didn't have access to the right networks, you couldn't get access to things like this. And so it's opening up a lot of doors for people that didn't have that before. And then, I mean, really anything you can think of, a DAO can be created behind. I think there's a lot of opportunity for branded products to basically allow their earliest adopters and customers to have ownership in the company and promote it and help them advertise it. And the more they advertise, the more they buy their products, maybe the more equity they get in the company. So there's a ton of flexibility and creativity that can be leveraged with DAOs. That's really exciting.
Yeah, I like how you touched on both sides of DAOs here. You can be on the entrepreneurial side and be the creator of the DAO, or you can be the person that contributes to the DAO and adds value to whatever service that they need at the time. You alluded to it. There is regulation or maybe lack of regulation in this space. Let's talk about what sort of regulation and guidance that we have. And maybe Brian and Neal, I'll start with you both from a tax perspective.
Yeah, I'll just continue and then I'll let you go, Neal. I would say the first thing is from a tax perspective, what jurisdiction is this DAO in? I mean, it kind of sits in the cloud. There's no one server room that you can point to because it's run, on the blockchain and on, thousands of people's computers. So, and likely this DAO has, thousands of contributors that are all around the world. So you potentially have, international tax issues if you can even determine, well, what jurisdiction is this? Is this in the U.S. jurisdiction? Is this the Cayman Islands? Is this, where is this? So number one, which jurisdiction can actually go after this DAO? And if it's like a corporation and it's retaining profits, it should be paying taxes on this. But right now, I don't know that anyone knows who can actually go after it and demand the taxes from it because they don't really know in whose jurisdiction that business lies. And then you also have all of the contributors. They're adding value. They're essentially independent contractors. I don't know if they're issuing 1099s or W-2s, depending on the time they spend at that company. So there's certainly a lot of questions on the tax side, and obviously from the SEC perspective, which I'll let Jeremy and others jump into, is are they issuing securities? Are they raising capital? What's going on here? So you really got to look to the underlying business model and seeing who's benefiting from what to kind of better understand, what kind of regulations it should be subject to.
Another question is, what kind of entity is a DAO? Is it a partnership? And if so, how on earth are you possibly going to connect, the owners of these tokens to say, oh, this is a partner or this isn't a partner? And it's very easy to get in and out of these organizations. And so I can only imagine the 743B calculations you would need to do if you're trying to say that, each of these token holders is a partner. And on top of that, from a SALT perspective, I think it's going to be really confusing on, how are we sourcing, the revenue or payroll or whatever it is. Probably a lot of these DAOs are not going to have a physical location. And so how do you source all of that, and state and local tax implications could become pretty confusing. So I think for the DAOs, there's going to be a lot to sort out there. And like anything really with crypto right now, is we're going to have to wait for the regulation and the legislation to come about.
Yeah, and we talked to some of the DAOs, but there are obviously a lot of DAOs that are focused just on decentralized finance, like some of these decentralized exchanges and other decentralized applications that allow people to do finance. And they're transacting millions, if not billions of dollars in transactions right now. And I don't think they're paying any taxes on any of that. I don't think that there's any financial reporting going on right now because who's responsible for it? There's not one person you can go after. You could maybe go on their Discord channel or on their website and try to see who's adding value. But a lot of times they're not even going by their real names. They're going by their, screen names or Discord handle names, it might be just a completely different name. You'd never be able to really track it back to that person. So it just creates a kind of a tax nightmare. And then you kind of layer on the traditional tax guidance of treating cryptocurrency as property. Okay, well, you get just like with mining, or if you're a contributor, you're getting paid. Let's assume that it's treated as ordinary income. You receive a 1099 and it's worth $1, and you hold that. and then it goes up to $2, and then you sell it. Well, you've got $1 of ordinary income and then $1 of short-term or long-term capital gains there. And so it just gets really complex from a tracking perspective, something that most people wouldn't have to deal with in a normal situation. So it's very interesting.
Jeremy, just maybe more from a broader perspective, just digital assets in general, what do our listeners need to know about regulations in the financial reporting space?
If we're talking just in general about digital assets, in the US, our financial system is a little bit different than in the rest of the world. We actually have a lot more regulators here than the rest of the world does. For example, we have the CFTC that regulates the commodities and derivatives markets. We've got the SEC that regulates public companies and investor protections. And then we've got the whole suite of banking regulators, right? In the FDIC, the Federal Reserve, and the OCC, and then the various states, right? Right now, a lot of companies that are transacting in digital assets, so the Coinbases of the world and the FTXs, all of those, if they are accepting US dollars in any form or fashion, then they're typically required to conform to like the money transmitter rules and laws in each state. Usually those require an annual audit. They also require other sorts of reporting, and they require KYC AML kind of processes. So anybody that they deal with, any customers that they take on, have to go through similar kind of KYC AML BSA type requirements that you would if you were opening an account at a bank. So right now, those are kind of the laws that are in place. And like I said, Congress and the SEC, the CFTC are kind of looking at who would be the best regulator for this market going forward. There's reasons for each of them to be. I think the latest that I heard was the CFTC put another notification that said, hey, we would be great regulators for this. So we'll see kind of where that ends up over the next year, but I think you'll be hearing a lot more about that.
Brian and Neal, I may come back to you more from a broader perspective when it comes to the taxation of cryptocurrencies. I know that there's a question on the front page of the 1040 tax return asking if you've been essentially involved in virtual currency over the last year. What other reporting requirements do our listeners need to know about?
I'll go first on that. I think most people today are probably using it as an investment, and so I think for the most part, people need to really be, if they're not using a centralized exchange that's providing adequate information, they really need to be looking at it from kind of a capital gains loss perspective, which would be reported on Schedule D. So really making sure they're tracking when they're buying and for how much, and when they're selling for how much, so that they can adequately track those capital gains and losses through the year. And then you can complicate that if you're participating in staking or mining, where you're receiving token rewards. If you're mining, typically that's going to be treated as ordinary income, kind of a sole proprietorship. So you'd file it on your Schedule C, offset it with any expenses you potentially have. And the second you receive it through mining, that fair market value that you receive it at becomes your basis. You just pay taxes on that. That's your basis. And then in the future, when you sell it, whether or not the value has gone up or down will dictate if you have a capital gain or loss.
Great info there. Neal, anything that you would add?
Yeah, I would add, and we haven't really talked about this, but something that can come up if you're really deep in DeFi and holding your assets in self-custody and staking, and then voting and governance, which we haven't really talked a lot about. But if you receive an airdrop, and what an airdrop is essentially is you're receiving free tokens from some blockchain. And there are a number of reasons why the developers might give different wallet holders free tokens in an airdrop. But suffice it to say, if you do receive an airdrop, whatever the fair market value is at the time when you receive it will be considered ordinary income. And that will need to be reported in the year you receive it. And now this can potentially result in some bad tax situations, because you receive that as ordinary income. But let's say if you receive some token on January 1st, and let's say you receive one token and it's valued at $10, just a simple example. And let's say by the end of the year, it turns out the token is worthless and now it's a zero. And so essentially what's happening is you are reporting $10 of ordinary income, but then essentially if you sell it and it's a zero, you're then reporting a capital loss of $10. Now, if you have the ability to take that capital loss against your ordinary income, that's fine. But if it were a much larger dollar amount, and I recently I saw a case where there was an airdrop where the airdrop receivers were receiving the fair market value was over $25,000 for the tokens they received. Let's say by the end of the year, if it's zero, well, you're reporting $25,000 of ordinary income, but then reporting a $25,000 capital loss. It's like, well, all of a sudden, I have this huge tax I need to pay on this ordinary income, and I'm not able to offset it because I'm limited to $3,000. And so you could potentially get into some really tricky situations. So just something that's kind of interesting in this area that can come up.
That's a great point. Again, going to come back to the Super Bowl, but Odell Beckham Jr., who's one of the Rams receivers, he's one of the few players that actually took his paycheck in Bitcoin. I can't remember the specific numbers, but he received, let's call it a few $1,000,000 worth of Bitcoin, but Bitcoin then I think it's down, we'll say 40% from when he received that Bitcoin. And so he was taxed at, that $2 or $3 million number, but now his, the actual value of that Bitcoin that he's getting is almost half of what it is. So at the end of the day, after tax, he's going to be in this situation where he may break even on this. And so hopefully he'll hold that Bitcoin and it'll go back up and it'll kind of end up benefiting from the situation in the long run. But it is a very interesting scenario where you receive the fair market value of something that's so volatile that could go up, and you might be paying taxes on something that you don't even have the money for.
One more thing I'll add, and this is a question that I haven't really, I don't know if I know the answer, but it's a question that's come up in the crypto Twitter spaces for people who have received these airdrops. Sometimes when you receive it, you'll claim it, but it isn't trading yet on a decentralized exchange. And so it's like, well, is the value zero? And if so, can I claim my basis as zero and then I have to report that as ordinary income? Or do I need to, like, once it starts trading on like a decentralized exchange, do I need to take that value instead and claim that as my basis? And so that's a question. I don't even know if I have the answer to that. It's something that's going to need to be figured out.
Yeah. Kind of going back to the airdrops, where I typically see them most is when a centralized application wants to become more decentralized. So a lot of times these startups will start off as centralized, and then they end up airdropping or giving out their token to all of their users as a way of saying, okay, now you are token holders, you are an owner of this company. And it's a great way for them to not only reward their early customers, but become more decentralized, where now people are voting and have some involvement in the governance there.
Right, and that's an important point because a lot of these blockchains, these developers, they don't want to hold, all the tokens themselves because they need people who are actually using their application. And so yeah, it is a great way to spread out and, like you just said, decentralize their holders and then get people to actually go out and kind of market their token because now they have this equity stake.
Yeah, that's also a good point to mention with regard to securities laws and when centralized organizations give out or sell their tokens to the public. That's one of the things that the SEC is very interested in. And a few years back, whenever you had the what they call the initial coin offering or ICO boom, where a lot of centralized organizations were selling tokens and taking those funds and helping out develop their projects and kind of get off the ground. Well, anytime, even if you have 95% of those projects that had the greatest intentions, you might have 5% that were there to scam people and to take advantage of people. And SEC was very interested in learning more about that and put about some enforcement actions. Those are the sorts of things that we will probably see a lot more regulation on in the future. There's regulation out there to deal with a lot of those things already, but we'll probably see more that's better fitted to the digital assets market.
Yeah, great point there, Jeremy. And, Brian, one of the things that I read about recently is this idea that because crypto is treated as property, wash sale rules don't apply to crypto transactions. And so I've heard of people doing some tax loss harvesting here at the end of 2021 to maybe offset some other capital gains or losses that they had throughout the year. Can you kind of elaborate to our listeners on what exactly that means?
Absolutely. Yeah. I mean, I think because crypto is currently not regulated, it's not treated like other securities. Like, if you bought shares of Apple or Microsoft through Fidelity, it's not regulated in the same way. And so currently, stocks, there are current wash sale rules that prevent someone from selling that stock at a loss and then repurchasing it back within 30 days. And so if you do that, that initial loss will be kind of added back. It won't be allowed for tax purposes. And so because crypto isn't regulated in the same way, currently, if you're in a loss position, or we'll say at the end of 21, if you're in a loss position, which a lot of people were because the market had come down, you could have sold your Bitcoin or ETH and then immediately repurchased it. And that would have allowed you to recognize capital losses to offset maybe some other capital gains you had from crypto sales earlier in the year. By selling it at a loss and then repurchasing it, you kind of end up in the exact same place. You just have a lower basis, but you still have the same holdings, but you're able to realize those unrealized losses for tax purposes. So clearly a benefit there. And I think that's definitely an area that the IRS and the government is trying to change.
We've talked quite a bit today about a lot of the use cases of crypto, from DeFi to NFTs to DAOs. It seems like you can really rack up a ton of transactions in a matter of minutes if you're really passionate and involved in any of these different protocols. So what are you guys seeing as some of the best practices for the accounting of some of these transactions and how to just keep track of everything?
So, Nik, maybe I'll just kind of start off by talking about the accounting in general and kind of where it sits right now, and then let some of the other guys dive into the specifics. So right now, the Financial Accounting Standards Board, FASB, has not addressed digital assets specifically. So whenever you have digital assets or crypto on your balance sheet, if you're a company under US GAAP, it ends up being an intangible asset after you go through various analysis. And under US GAAP, intangible assets cannot be held at fair value for the most part. So it causes a lot of issues when you have these things that are turning over a lot and would be great to be able to use fair value accounting for. You end up in this world where you're having to mark them down for impairment, but you can't write them back up when the value goes back up. So lots of issues there, but that's something that the industry is kind of screaming about, hoping that we can get to a better answer from the accounting standards setters. Also from just a presentation disclosure, how you actually present these and disclose these types of transactions. Really, there's not any standard guidance out there for that either. Companies, you can look at companies like Coinbase and companies like Circle that are public companies and kind of like see how they are disclosing, and it's really like an evolving area to ensure that investors can understand the business models and really understand like how they're making money and what types of transactions they're doing.
From a tax perspective, a lot of these centralized exchanges or even decentralized exchanges won't be issuing 1099s to our clients. So they're kind of on their own to figure out how many transactions they have, what time of the year, what the value was, and all those sort of things. Brian, Neal, are there any tools out there that maybe they can utilize to help them?
Yeah, exactly, Nik. I mean, a lot of these exchanges, they don't provide, 1099s like a Fidelity or Schwab do every year. That's likely going to be changing here because of the infrastructure bill that was passed. So starting in 2023, brokers, which is still kind of a gray concept in the crypto world. Does that mean just centralized exchanges? Does that mean wallets? Does that mean decentralized exchanges? So a lot of unknown there, but in the future that may change. But for now, most of the exchanges like Coinbase, they'll only provide you a 1099 miscellaneous if you have staking income or income from airdrops or other things like that that exceed $600. So it's a kind of traditional 1099 rules. But each exchange has a different level of tax reporting for the user, not necessarily they're not sending it to the IRS, but Coinbase has kind of a tax center that you can log into through your account that tries their best to help you track the sales that occurred through the year. But obviously, if you're transferring any of your holdings to a wallet off the exchange or doing other DeFi transactions, none of that's going to be reported by Coinbase. So you're just going to see the token being transferred outside of Coinbase, and maybe it comes back and they'll see that, but there's going to be a disconnect. They don't know what happened in the meantime. So you would then have to go to your wallet or to those exchanges and see what tax information they can provide you, or at a minimum try to download all the transactions in an Excel file and match them up, but it becomes really complex. And so right now, some of the best software solutions for doing that allow you to kind of plug in or integrate your wallets and exchanges would be maybe a coin tracker, a Legible, or a TaxBit. Those are kind of some of the the bigger names. One other thing just to keep in mind, because it's property, every time you swap Bitcoin for Ethereum or Solana or any other token, that's considered a taxable sale, even though you never got cash in your hand. Or it could be you bought the newest hot NFT and you trade it for another NFT, and people are doing this on a daily basis, probably not realizing that every time they're doing that, that's a taxable sale. Clearly, that can create thousands of small transactions that are hard to track and account for. There is some kind of pending legislation called the Virtual Currency Tax Fairness Act, where they're trying to exempt personal transactions with crypto that have a gain of $200 or less. So that may help ease some of that reporting when you're just maybe transferring from one to the other without selling it. It's going to be interesting to see, what does personal transaction mean? Does that just mean swapping, just like I'm swapping, exchanging my US dollar for another currency? Or does that mean I actually have to use that crypto to buy a personal asset like food or a coffee? So I think the US, through some of this legislation, is going to try to make some of this a little easier. And then ultimately, the exchanges will be forced to provide better tax reporting.
Yeah, some great points there. It does seem like this could essentially be an accounting nightmare for those that are involved. Jeremy, you mentioned the balance sheet treatment of this, or of digital assets as an intangible. Are there any other accounting considerations that you're seeing from your clients?
It depends on what type of entity you are. I mentioned that certain types of assets are classified as intangible assets, and for just normal operating companies, that's the case. If you're a broker dealer, the accounting would allow you to use fair value in certain cases. Also, if it's an investment fund, then you can get to fair value in those cases as well. I think that what we'll see more of as other types of activities become more prevalent, you get you get into some really fun discussions when you talk about lending crypto, because what ends up happening is the lender oftentimes can't de-recognize that asset. So, I may lend you some crypto, Nik, but that asset still has to sit on my balance sheet because it doesn't meet the accounting rules for de-recognition for me, but it meets the recognition criteria for you. So now there's two sets of crypto that are the same crypto on both of our balance sheets, right? So you'd run into some really strange issues sometimes when you get into some of these transactions. But hopefully the FASB will step in, that we'll be able to get some more clarity here. But it's been really fun talking this through with industry experts over the last few years.
I love that example, and just kind of a flavor of just how new we are to regulation in this space, and how just even the concept of two different organizations having the same crypto on their balance sheet. That's super interesting. Let's switch gears here a little bit. Let's say I'm a newbie and I want to get started in crypto. Where would you guys tell me to start?
I'd say there's a couple of different ways you could start. For those that just want to learn more, but maybe not actively delve into it, there's just tons of great videos online. Andreas Antonopoulos is one of the guys that's been in the Bitcoin space for a really long time, and that's where I learned a lot about the basics of this whole cryptocurrency stuff early on. But then there's those people who are going to want to get their hands dirty and learn by experience, and that is the more fun way, in my opinion. Maybe watch some of those videos and then start dabbling a little bit, just with a very, very small amount of money, not looking at it from an investment perspective, but just the mechanics of how do these transactions work. And we've mentioned Coinbase a few times. That's definitely a great one to start with, but there is going to be quite a bit of paperwork because they do have to adhere to know your customer requirements and all that. I recently downloaded an app called Voyager that made it really easy to use just a credit card and buy a very small amount of cryptocurrency. What I would suggest is, if you're going to go that route, probably not dabbling with Bitcoin or Ethereum initially because of the transaction fees being so high. I mentioned earlier on that if you execute a Bitcoin transaction, it might take you $20 in fees just to make that transaction happen, and in Ethereum is just about as pricey as well. As much as I don't think there's any utility in like a coin like a Shiba Inu or something like that for learning and seeing how that transaction executes and actually feeling that sensation of that money being on your phone, that's not a bad one because the transaction fees are very, very low, and it's kind of fun. That would be my suggestion, is an app like that, like a Voyager app, to acquire it. But what I would also do then is get a wallet on your phone that's separate from that and like transfer money between the wallets to see that transaction occurring. And then also exploring the other wallets. Like there's a really cool wallet called MetaMask that is an add-in for Google Chrome. That's a really interesting one too, that kind of lives behind the scenes on Chrome until you're on a site where you could send crypto to, then that wallet kind of pops up. So that's a fun one to explore with, but I would say just get, a very, very small amount of it and start moving it around a little bit to get that excitement level up from the first transaction that you execute.
That's a great point about starting number one with small dollar amounts, because you may get into a situation where you just transferred some of your crypto somewhere and you can't find it. I mean, it just happens because, or maybe you sent it to the wrong address, the wrong wallet. I mean, so always start with small dollar amounts. And because Bitcoin, Ethereum are so expensive to transact on right now, because they basically kind of hit the mass capacity from a transaction perspective. And so I think as Neal had mentioned, Ethereum's kind of going through this bridge or this upgrade to Ethereum 2.0, where it's going from proof of mining to proof of staking. And so the thought is that that'll allow for a lot more scalability and lower gas fees. And also Ethereum, which people call as a layer one, because it's the first layer of kind of this decentralized computing platform. A lot of layer twos, like Polygon, for example, are building on top of Ethereum to create more affordable transactions. Typically, when people talk about transaction fees, they talk about gas, like the gas to use this, just like you pay for gas for a car. And so gas is kind of another term for transaction fees. And some true crypto, especially on the Ethereum blockchain, the believers, they say that gas fee or that transaction fee, that's like paying an attorney. Instead of paying an attorney $5,000 to write up this agreement, you have a smart contract that just executed it for you, for $20, $100, wherever the fees are, right? So that's one way to look at it. Obviously, it's difficult when you're doing high volume transactions, specifically in DeFi. When we talk about fees or gas, those fees are going to miners, or they're going to validators, people or computers that are validating those transactions. So the fees are going somewhere, just like the fees go to Visa or to PayPal. These fees are going to essentially a decentralized network of computers that are validating transactions and making sure that every transaction is correctly reported on the blockchain. And I would agree, YouTube is a great place to go to. Just anything you can think of nowadays, just Google it on YouTube, and there's someone that's going to have an explainer video on how to do it. And if you say, how do I open a Coinbase account? How do I trade? How do I do this? I mean, there is a video and probably show you step by step how to do it. So it's a great time to learn, but definitely be careful. Don't risk more than you can afford to lose, and use small dollar amounts.
I would say that if you're getting into it, one of the fun things about this is each chain, each token is going to usually have a group of developers behind it that have a white paper. They have some philosophy, they have some theory about why they're getting into this, why they're doing it. Those can be kind of fun to poke into sometimes and just learn a little bit more about the ecosystem. One that comes to mind for me is just Solana and kind of what they're doing. They're, one of the problems with kind of like early blockchains is that they ultimately are end up being slow, and it's hard to get a lot of transactional throughput. So when you're thinking about like, do we really have enough transactional throughput to be able to treat digital assets like we do like credit card transactions, right? It's really tough to do that because the limitations. Well, like for example, Solana is approaching some of those same kind of like transactions per second that like a credit card network might do. So it's really kind of cool to see what some of these developers and some of these projects are actually setting out to do, and kind of follow along with that.
Yeah, the last thing I would add is, if you're gonna be looking on for videos and you want to get more broad sense, I think one of the best YouTube channels out there is Coin Bureau. I wouldn't be surprised if everyone here on this come across this at least once or twice, but he spends a lot of time making these videos on cryptocurrency and NFTs and DAOs, and does a really, really good and thorough job of discussing these topics in an objective way. He's not going to be, shilling random coins on you. He does a really good job of teaching this stuff, and I think he's one I could easily recommend to go to.
Yeah, that's a really good point, Neal. Any other resources that you all know of that would be great for our listeners to go and just learn more about crypto?
I guess just with the position that I've been able to be a part of the digital assets working group for the ACPA, I will say that we put out white papers. And so if you're interested in learning about the various risks of digital assets from an auditing perspective, there's really good white papers out there. The accounting group also does several white papers and FAQs on that topic. So put a plug in for that.
Well, I guess I'm going to jump back in here now. I mean, it's been kind of nice. I'm usually the one that's asking all the questions, and man, Nik, you got it down, buddy. But I appreciate the all of you. I've learned a lot just by listening to you all. So I'm sure it's something we're going to continue to talk about, no doubt, right? I mean, it's obviously continuing to evolve, and we'll learn more. So I have a feeling that we're going to be in touch here, and maybe have to do this again, get the band back together again here in the near future. But is there anything that anybody would add or mention or throw out there?
I would add one little tidbit that I've always thought would be very cool. Like if we get to a world where everybody's on crypto, this would be possible. So it's not anything that's going to happen short term, but just think about like your accounts receivable process. You send a bill, they cut a check that goes through the mail, then you got to look and see what the invoice number it is and match it up, and then we get the email from somebody saying who's this payment applied to. A lot of that can be cut out if the transaction is just instant. It goes in. You could create for each individual invoice, you could create an address for that, and then once that gets paid, automatically have that update in your accounting system to show it is paid. I think there's a lot of cleanup that could happen.
Yeah, that's a great point. And I think on that note, the transparency it could bring to financial reporting. We touched on DAOs. They're these transparent, organizations where you can go in and see what they're doing, where money's going, how it's being used. Well, in the future, I think a lot of and it's already happening now, but a lot of those transactions are going to be used to create real-time dashboards. So maybe these companies don't need quarterly financials anymore because they don't need months to prepare them. They're already prepared in real time by basically aggregating all of the transactions from the blockchain. They're completely transparent. So I think there's potential disruption that comes to financial reporting given the transparency and the real time data that's available.
Before we wrap up, there are a few recent developments in the U.S. digital asset world that Geron and I discussed in that conversation I mentioned earlier in the episode that you'll find on our YouTube channel. Here's a clip from our conversation. And maybe with that in mind, I know there was an announcement pretty recently here from the White House, and maybe there's more to come, but what's happening there, and maybe what does that mean from your perspective for, I guess, the future potentially of digital assets?
Yeah, and I trace this back even late 2021 when the Senate Banking Committee started having conversations about crypto. And so that was the first kind of sign to me that like, hey, they're going to legitimize this, because the reception in that banking committee was very positive. And the discussion was more of how do we regulate this from an intelligent and concise manner? And do we need to form a separate agency, or do we need to house this under banking? So it was almost like they were progressing in their thought past the idea of, is this a real thing? Biden's executive order related to crypto digital assets, directing the parties that be within the federal government to come up with a plan and policy for digital assets with the intentions of making sure that consumers are protected and that there is financial stability in this environment. And I think this is great. Every time I do a speaking event or every time I talk about crypto, the $1 trillion asset level is there, of the volume of trading that's happening every day. And so if you think about how much money is wrapped up in just that line in those transactions every day, I do think there's a need to protect people. I mean, because this isn't just, your experimental traders anymore. These are people with retirement plans. These are people that have, an idea of what they want to do in their future. And the reason why the federal banking system is set up and the reason why the federal government gets involved in those things is to protect people. So I think that's a great way to start the journey that politics and crypto would go about together, kind of thing. And so, you have a couple other things in there. He's talking about financial inclusion, and he's also talking about responsible innovation in the executive order. But, the facts and circumstances of what the White House put out about it, where we're giving crypto a thumbs up, we're going to legitimize it, and we're going to put rules in place to protect the people that are investing it. Now, there's some other politics that surrounded that, and what generated the need for that to come to the forefront now. And probably most people are aware of what's happening in Ukraine and the sanctions that were placed on the Russian government. And so when those sanctions went through, it blew up in the digital asset world of, well, here's your business case for where some illicit activity may, or the illicit activity in the domestic mindset. This is where Russia can go around the payment systems that are out there. They can start using Bitcoin in order to transact and keep their money moving through the environment. You've also seen that on the other side. You've seen Ukraine receiving digital assets in order to help them keep their financial system moving. So I think it was spurred on by trying to maintain the sanctions in place that Biden had tried to structure. But it was something that was coming anyway in my mind. So either way, it's good. And I think we will see the benefits of this, not only as investors in the digital assets markets and in the development of our economic system, but I also think that we will see it just from the health of our financial system with crypto and digital assets incorporated into it.
I'd like to thank Brian, Jeremy, Tom, Neal, and Geron for not only sharing their vast knowledge in this rapidly evolving area, but for also helping me personally better understand it as well. I'll give a special shout out to Nik Fahrer for arranging and facilitating this conversation. You did a fantastic job, Nik. You can learn more about digital assets and get the additional resources that were mentioned during the episode today in the show notes available at bkd.com/simplytext, which is where you can also get the contact information for each of our guests today. We want to know what you think about the podcast, so please let us know with an email at simplytax@bkd.com or on social media. You can find me out on Twitter, where I tweet about tax at Damian Martin CPA, on Instagram at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I would also greatly appreciate it if you would leave us a rating and review on Apple Podcasts or wherever you find your podcasts, as it helps others discover Simply Tax. I'm Damian Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.